Hey, Eamon, yeah, moving patterns are actually holding, but home prices are weakening in some of the still hottest migration markets, in part because of higher mortgage rates, but also due to the demographic makeup of those moving in. This is according to a new study from Bank of America. Take a look at the top 5 markets for population growth in the first 2 years of the pandemic: Tampa, Orlando, Austin, Phoenix, and Las Vegas. These markets all saw home price gains between 30 and 50%, according to CoreLogic. They are all still seeing population growth, albeit about a third as much. But prices in these markets are now reacting differently. Last year, even as mortgage rates doubled, home prices remained strong in Tampa and Orlando. But Austin, which still has positive population growth, saw prices fall. Vegas and Phoenix saw much smaller price gains. Why? Well, demographics and home building. Austin's inflow is largely younger Americans, many of whom are either renting or buying less expensive homes. Compare that to Tampa and Orlando, where wealthier baby boomers are heading, boosting prices. There was also heavier home building in Phoenix and Austin, leading to more supply, which always tempers prices. As for cities with the big pandemic outflows, well, New York, Boston, San Francisco, San Jose, and Seattle. In the first 2 years of the pandemic, prices there gained despite the outflows, likely because of low supply. And last year, those markets still lost population, but prices held positive in New York and Boston, but they went negative in the other 3. That's because pre-pandemic, prices in the West had overheated so much that they just had harder to fall. There's also less supply in those Western cities. Eamon?
Diana, thanks. Now, for more on the health of housing, our next guest is giving us an exclusive preview of their housing report coming out Monday, and it shows affordability isn't improving. So for more on that report, let's bring in Andy Walden of Black Knight. Andy, what did you guys find in that report?
Yeah, and I think this adds another wrinkle to what Diana's talking about, because if once we look at May data, right, our latest home price index, what you see is some really strong firming, and I would venture to say heating out there in the housing market almost universally. So those markets that Diana was talking about, your West Coast markets that had been seeing prices fall, they're now firming up as we move into the summer months on a lack of inventory.
Diana, you were talking about this earlier, these 7% mortgage rates. I wonder who the buyers are then in all these different markets who are able to take on that kind of debt.
Well, it just means whoever has that kind of money to put down, or if you're not using a mortgage at all, which we're seeing an actual rising share of home buyers are going all cash because they want to be competitive. But look, you know, yesterday we had the CEO of Compass on, and he said 7 was the new normal, and that was fine. I got to say, I don't really buy that. I think when it comes to affordability with higher home prices and mortgage rates now over 7%, there simply is a line where some people either can't afford that monthly payment or they're not going to qualify at that rate.
Andy, what do you make of what Diana was reporting earlier, this idea of demographics and migration patterns post-pandemic really shaping the housing market for years to come?
Yeah, I don't know about years to come, but absolutely it has the last couple of years, right? And you saw this big inflow into those markets. You saw, as Diana talked about, they overperformed the market significantly with this outside money coming in. And now you're seeing those markets more reliant on local market income. And as Diana talked about, if you look at rates getting up to 7% yesterday, according to our Optimal Blue data, home affordability just hit its lowest level in 37 years. We're past where we were in October of last year. So to your point of demand out there and who's buying, I think you're going to continue to see a lot of downward pressure on demand. It's just this lack of inventory that continues to hold prices where they're at.
And what's going to convince people to actually sell and produce more inventory?
Yeah, I mean, that is the key question, right? And sellers have shown no inkling of returning back to the market. Those existing homeowners that are the lifeblood that drive 85, 90% of all listings continue to back away and back away and back away this summer. And even if when we saw rates get down to 6% earlier this year, you did not see any semblance of them returning. Now, the one place that we've seen some bright spots is the new build. We saw an overperformance in May. We still have a lot of units under construction. So that's the only spot where you can see some inventory coming to market, and that's going to be a big player as we move forward. But the distressed inventory, foreclosure levels, delinquencies at near record lows, existing sellers unwilling to sell. So it's going to have to be those new builds. I just don't think there's enough volume there to return us to normal.
Andy, we just have a couple of seconds left in the show, but I do want to get your thought on what could break that logjam. Is it just build, build, build?
I mean, I think that's part of it. I think you're going to see the more pressure put on the Fed to keep rates high for long, and I think you're seeing that. The market kind of realized that over the last couple of days with bond yields and 30-year rates holding high. I think it's going to be continued Fed pressure, and absolutely building is going to be a component of it. I just don't think that's going to get us all the way there.